MACD is the oldest momentum oscillator most desks still watch, and that consensus is exactly why it moves price. It compresses trend and momentum into one panel, telling you whether the short-term drift is accelerating away from the long-term drift or quietly reverting. Today we are dissecting the math, the signal line crossovers, the histogram, the zero line, divergence, and most importantly the lag that traps undisciplined traders. By the end you will know when MACD is signal and when it is noise. MACD is just the 12-period exponential moving average minus the 26-period exponential moving average. That difference is the MACD line. Smooth it again with a 9-period EMA and you get the signal line. Subtract signal from MACD and you get the histogram. Because EMAs weight recent prices more heavily, MACD reacts faster than a simple moving average difference, but it is still a lagging construct built from past closes. Remember that? Every MACD value is yesterday's news, mathematically smoothed. Think of the MACD line as fast momentum, the signal line as smoothed momentum, and the histogram as the rate of change between them. When MACD is above zero, the fast EMA is above the slow EMA, so trend bias is up. When the histogram is expanding, momentum is accelerating. When it is contracting while still positive, the trend is intact but losing thrust. That distinction between direction and acceleration is the whole game. The classic entry, MACD crosses above the signal line for a bullish trigger, below for bearish. On a synthetic uptrend, you can see the histogram flip from red to green right at the cross. Advanced traders do not take every cross blindly. They filter by location. A bullish cross deep below zero, while price is still in a downtrend, is a counter-trend signal with low win rate. The same cross above zero, inside an established uptrend, is a pullback continuation, which is far more reliable. The zero line is where the 12 and 26 EMAs cross. Crossing zero is a regime change, not a tweak. A MACD pushing from negative to positive after a base is a much heavier signal than a signal line cross because it confirms the underlying trend structure has flipped. Many systematic traders use zero line crosses as the regime filter and signal line crosses as the timing trigger. That stack reduces false entries dramatically. Here is the uncomfortable truth. By the time MACD prints a clean cross, price has often already moved a meaningful percentage. With default 12, 26, 9 settings on a daily chart, the effective lag is roughly 8 to 12 bars. That is fine for swing traders riding multi-week trends. It is brutal for short-term scalping, where you will routinely buy the top of a swing and sell the bottom. Match your MACD settings and time frame to the move you are trying to capture. In sideways tape, MACD will cross the signal line repeatedly, generating a string of small losses that grind accounts down. The histogram alternates colors every few bars with tiny amplitude. That low-amplitude histogram is itself the warning sign. If recent histogram bars are visibly smaller than the prior trending leg, you are likely in chop, and MACD signals should be ignored or faded. Pair it with a trend strength filter to stand aside. Divergence is where MACD partially escapes its lag. If price prints a higher high but MACD prints a lower high, momentum is fading even as price extends. Bearish divergence. Reverse for bullish. Treat divergence as a warning to tighten stops or take partial profits, not as a standalone reversal entry. Many strong trends produce 3 or 4 divergences before they actually turn. Wait for a structural break in price to confirm. Here is Apple on the daily over the past year. Notice how the cleanest signals come when MACD crosses zero alongside a clear higher low in price. The signal line crosses near the zero line in the middle of the chart, generate the worst whipsaws, exactly where price is balling up sideways. The best trade of the year is preceded by a small bullish divergence and confirmed by a zero line cross. That is the playbook stack working in real conditions. MACD does not work alone. Stack it with ADX above 20 to confirm a trending environment, which kills most range whipsaws. Use RSI to verify you are not chasing an exhausted move. Add a higher timeframe MACD as a bias filter. Only take daily long signals when the weekly MACD histogram is positive or rising. This multi-timeframe alignment is the single biggest edge improvement you can make without changing the indicator itself. 2 pitfalls dominate. First, traders compare absolute MACD values across different stocks, which is meaningless because MACD is unbounded and scales with price. Always read it relative to its own recent range. Second, the defaults of 12, 26, 9 are not sacred. For faster timeframes, try 5, 35, 5. For weekly swing systems, some use 19, 39, 9. Backtest the settings on the instrument and horizon you actually trade. Tomorrow, before you act on any MACD cross, run this checklist. Is the zero line confirming the direction? Is the histogram expanding or contracting? Is ADX showing a trend? Is the higher time frame aligned? If 3 of those say yes, you have a high-quality signal. If not, pass. MACD is a lagging tool, but stacked correctly, it remains one of the most robust momentum filters available. This is education, not financial advice. Trade your own plan and manage your risk. If this helped, do me a favor. Hit the like button, subscribe, and tap the bell so you don't miss the next one. See you in the next video.